What's up guys, my name is Kevin Murray, and today I'll be talking about the risk factors for investing into individual equities or specific stocks in the stock market in 2022. Statistically, like individual stock pick or mutual funds can't beat the market. I read a book called A Little Book of Common Sense Investing. It talks about like Jack Bogle, and he's the founder of Vanguard, a big financial institution in the world, one of the biggest. And he says like most mutual funds can't beat the market, and statistically why? Because mutual funds, how they make most of their money is from fees from their clients and fees from just going in and out of the stocks. Like they're not a long-term investor, you could say. Their time horizons is year over year. They want to get the biggest stock performance or return in that one specific year. And if they don't, they'll be judged by their peers and people around them. Like, well, this guy or hedge fund made 20%, but you only made 15. Why is that? And there was just many factors to it. Like they're more short-term trading. They're not more long-term buy and hold. And number two, like their fees too. Like when clients like invest into these mutual funds, like if you do like the compounding type of calculator, let's say like index fund returns at historically 10%. And mutual fund returns 12 or 13% over long-term periods of times, but you're paying 2-3% for what? For very many different factors, from paying the mutual fund guy 1%, paying fees for getting in and out of stocks, or number two, like taking your money elsewhere. Like there's so many hidden fees that not a lot of people like are aware of it. And something just to be aware of, like you don't really need a mutual fund or financial advisor to just do an index fund type of investing. Just you should be aware like where you're spending most of your money or your expenses or your income. From past videos of mine, like have an app to track your income and expenses. You could cost average into an index fund. You don't need a financial advisor to tell you that. It's very simple and common sense. It's like the fees that kill you. It's very rare in terms of me, like in terms of age, in terms of people too are financially educated, who takes time to research individual stocks. Most people are lazy and like they just want to take the easy route. Oh, I want to invest into the hottest thing in the markets right now. People like chase stock prices. But if you do that, you're gonna be like the masses, be like sheep mentality and not get the gains. Like there was a famous investor called Peter Lynch, and he I told the story before my channel. Like he ran a very famous fund called the Magellan Fund that returned over like 28% in the 70s and 80s, and like most of his clientele, they were chasing the tops and they were selling at the bottom. So who was making most of the money? Only Peter Lynch. His clients didn't have that right mindset. As an individual stock picker, you gotta like experience the market daily. Know what it takes. Like the more you experience it, the more you get wiser what drives the market in the short term and long term. And like you're gonna be bashed when you're an individual stock picker when the market is down, and you'll be praised when the market's up. Remember like Kathy Wood and stuff, or even like Warren Buffett, or financial education too. It's also like your risk tolerance too. Like you want to put in the work to be individual stock picking and get bigger returns and compound your money faster, or do you want to be like a more passive type of index guy, or do you want to be like a crypto or real estate or even like day trader? Like pick what suits you. Because for me, I resonate with individual stock picking. I'm more 4 or 5 year outlook on these specific companies that are growing, good management teams, and have fundamentals going for them. Like they seem undervalued in terms of intrinsic value, or doing a DCF, or just running my own projections onto it. But when you're an individual stock picker, you shouldn't invest for your family or friends, like if they don't want to put in the work. It's only you. You only care about yourself and people that actually take this seriously. If you like investing and you want to put in the work, it'll pay off over long-term periods of time. It seems boring. We'll see how it goes like 10-15 years down the line. Oh, I wish I took your advice, or I wish I started investing earlier. These are the tools, the systems, or things I do on a consistent basis to become where I want to be over long-term periods of times. And individual stock picking shows like I'm a more risk taker, and like I want to take more risk in my life. The idea of risk in being comfort. I'm more risk adverse when I'm young because I could do it. I'm going to learn my lessons and I have the time to do it. And when you get older, you can't take those risks. Like in your 20s, like why not go the unconventional route? Start your own business and see where it goes instead of doing the 9 to 5 after college, getting your undergrad. But it's in terms that's like social conditioning and like deeper subjects about life. I'm just going to go back to like individual stock picking. Show your track record and just document. Like sure, I might be losing money in the short term. My portfolio might be down maybe 25% year over year, but we'll see. I'm just learning and I'll be wiser every single year. So just think for yourself and just trust the process for you. Like you want to grow your income, get your income right first to grow your portfolio and all that kind of stuff. Now another thing is like most people are just stagnant in life. They don't really care about finances. They're comfortable. It's cool. But you should take a risk when you're young and doing the unconventional route, thinking outside the box and see what happens. But we never know. But thank you for watching, and peace out.